Greetings. It is time for our monthly monetary creation report. And this report is always important because it enables us to measure whether exponentially rising monetary creation, money printing, is in fact being offset by technological deflation, and how much money printing is being done in a worldwide total, and how that ties to worldwide inflation measurements, because despite the narrative that money printing has caused hyperinflation or could cause high inflation, the data has consistently told us something quite different, and I've been saying this for many years, as longtime viewers know, but I am surprised how few people are interested in changing their belief system because the data proves the narrative to be wrong. Apparently, evidence doesn't deprogram dogma quite yet. So as always, we go to this Yardeni report, and we go to this first chart about the four major central banks of the world that comprise about 85 to 90% of all the world's money printing. The US Federal Reserve, the European Central Bank, the Bank of Japan, and People's Bank of China. And the red line is the US Federal Reserve. And as you can see, it's the joint highest of the four along with the European Central Bank, but it has only done 8.5 trillion out of this total. So it has done less than 1/3 of all the world's money printing. A lot of people who think money printing causes inflation tend to conveniently assume that the United States is the only country in the world. They say things like, the US is printing so much money, that's why gold should go up. Well, what about the rest of the world? The United States is not the only country in the world, and it's not even the majority of world money printing. It's the joint largest contributor, but still less than 1/3 of the total, as we shall see. The US Federal Reserve has done 8.5 trillion. Japan is actually the smallest of the four in total dollars printed, but it's the largest of the four in terms of how much it has printed in proportion to the size of its own economy, as we shall see. But since all money printing is worldwide, the size of a domestic economy is of very little importance, because only this worldwide total matters, because technological deflation is worldwide and commodity prices are worldwide. So only worldwide totals matter, and that is something the narrative just doesn't teach people. So scrolling down, this chart is the sum of the four central banks that we saw above, and therefore is the correct measurement. The grand total, $28.5 trillion. There's how much money has been printed. Money printing did not just begin with COVID-19, as some people seem to think, because they say that money printing has caused inflation, which it has not, as we will see later in this video. But money printing actually began in the 2008-2009 crisis and has been consistently rising exponentially. The formal economics establishment is unable to figure out why every time they try to stop and reverse money printing, they're forced to do more, because they cause a market correction, and that makes the economy veer on the edge of recession, so they have to print more money. And that is all of the central banks of the world. And this grand total seems to be rising in an exponential trend. The people who think this money printing can be reversed still seem to think that this line should go all the way back down to here, reversing all of this $28.5 trillion of money printing, whereas I say this is the exponential trend line, and we should already be over here. So we're already a good $10 trillion behind, and we will have to catch up relatively soon, one way or the other, because even staying flat makes us fall further behind the trend line of where we should be. And this is a good thing. It's not a bad thing, because this is a monetization of technological deflation. It's just that this monetization has to be utilized in a better manner than simply buying treasury bonds and mortgage-backed securities in the US, and the equivalent is done in Europe and Japan as well. So this $10 trillion reversion will occur before too long for certain. However, notice how they cannot deprint much anymore. They deprinted this much, which is only a small fraction of the COVID-19 money printing, which would have been done anyway, because it just got us back to this trend line in the first place. But this very weak reversal of money printing, which was very gradual, it took them a full year to get from here to here, has already been reversed to some degree and is now treading water. It is at a flat level. It is no longer being reversed. So they cannot deprint anymore. All those PhD economists can't seem to figure out why, but here is where we are relative to pre-COVID-19, which was here, and they cannot deprint anymore. Now, I've often said that this growth rate has to be 16 to 24% a year just to offset technological deflation, and that has continued to be true. My Atom publication is something I released in early 2016, which means I wrote it over the course of 2015. So what is this annual growth rate? For that, we go one chart lower. This is the annual growth rate, and it peaked in February of 2021. This was at 46.3%. And even I thought that this is a level that could cause some temporary inflation, and it did cause a little bit, as we'll see in part 2 of this video, but this got reversed very quickly. 46.3% is above the 16 to 24% band that I recommend, but then it went below this band and to negative, that reversal that we saw, yet the extent of reversal is itself being reversed. So we're back to a status quo of either not deprinting any money or even net printing, and this percent year-over-year growth rate is converging back up to 0. 0 is not good enough, however. We have to be at 16 to 24, and that involves this line going up to here, just like in the chart above. This would have to go all the way up to here to intercept this trend line, one way or the other. And now lastly, we shall see this chart, which I often speak about, because it's so silly that people say the US Federal Reserve has printed so much money and that's why gold will rise. And gold has not risen. Gold is in fact the same price as 12 years ago. And oil is much cheaper than it was 12 years ago. So how can people still say that money printing causes inflation? It does not. The data proves otherwise. The people who say that are people who want to avoid the data because they memorize something and it's too much work to learn something new. This chart being the percentage of each domestic economy that each central bank has printed. The US is the joint lowest of the four with the People's Bank of China. So the US is not a big contributor of money printing as a percentage of its own GDP. Europe has done twice as much money printing as the United States, 62.2%. You would think that Germans are the people most afraid of money printing and hyperinflation, but they still have done twice as much money printing as the United States. But the highest of all is Japan. They have done an incredible 129.1% of their GDP in money printing. Now, in the case of all four of these lines, this is a cumulative multi-year total of money printing, while GDP is an annual metric, but it's still a valid measurement in relation to one another among these four. And Japan has done quite literally 4 times as much money printing as the United States in relation to the size of its GDP, and no one claims Japan has high inflation. Japan has been in deflation for 30 years, and that's why they printed so much money, and they still don't have inflation. In fact, they are running out of ideas about how to create domestic inflation because deflation is much worse than 3% inflation, as I often explain on this channel. A lot of people don't understand that either. They think deflation would be good. That is a dangerous belief if a significant percentage of voters think that. And in the US, that narrative is being pushed. But in Japan, they know that deflation is bad because they've already experienced it for 30 years. So Japan has done 4 times as much money printing as the United States in proportion to the size of its economy. And nobody claims that Japan has high inflation. Even the people who claim that the US has hyperinflation and that US metrics are rigged to understate inflation, which they are not, as I will show in part 2 of this video, even those people don't claim Japan has high inflation. So the notion that money printing causes inflation is completely wrong because those people are all thinking about memes from 50, 70, 100 years ago. In some cases 110 years ago, because that is when they say the US dollar started to devalue, or whatever their weird narrative is about why gold is something they should buy and that expecting gold to go up is wrong. You're just supposed to buy it and expect that it never goes up. Now we go to my scorecard of my prediction relative to the prediction of the economics establishment. This is a scorecard that I reveal every month. And at the start of this decade, meaning January 1st, 2020, I said that money printing was rising exponentially because I've been saying that since 2016. And I know what the trend line and the rate of growth is and what percentage of the total world economy is high-tech and the rate at which even that is increasing. Therefore, it's not that difficult to figure out how much technological deflation there will be at a given time, and therefore how much money printing is needed to offset that, as well as the gradient at which this exponential deflation is rising. Therefore, the economics establishment saw that in the 2010s, $23 trillion of money had been printed. That is the first $23 trillion out of the cumulative $28.5 trillion of money printing we have seen as of May 20, 2023. So they thought that the first $23 trillion would even be reversed. $23 trillion was done in the 2010s, therefore we will reverse that in the 2020s in short order. So their prediction of how much net money printing in the 2020s was minus $23 trillion, whereas I said something very different. that we will have to do another $50 to $100 trillion over the course of the 2020s just to offset the exponential technological deflation. $100 trillion if it is done in the form of mortgage-backed securities and treasury buying that is done today by the U.S. Central Bank and other central banks of the world doing the equivalent with their instruments. And that is already unsustainable because that is distorting some very small sectors of the economy at the expense of all others. In the United States, you could hardly invent a more precise mechanism of printing so much money in a manner that does not circulate to the bottom 98% of people and does not improve confidence in the economy despite the rising total net worth of the country. It is a very, very unevenly distributed form of money printing that leads to all of the printing accessed by a few people near the printing spigot rather than a broad-based diffusion. I say send cash directly to people and have that offset income taxes gradually as the tax burden shifts away from humans and onto technological deflation, meaning automation and artificial intelligence and so forth. And if it was a more cash-heavy method, that would need only $50 trillion in this decade. So I said plus 50 to plus 100 trillion, whereas the PhD economists said minus 23 trillion on January 1st, 2020. Remember, they are referring back to textbooks written 70 years ago, and they have memorized those textbooks. And what are the actuals? To date, about 1/3 of the way through this decade, because this is through the end of April of 2023. So 40 months in out of 120, exactly 1/3 of the way through this decade, we are now at plus 9.2 trillion. And remember, this is exponential. You wouldn't get 1/3 of this amount in the first 1/3 of the time. You would get much less than 1/3, with the bulk of it coming later in the time series because of the exponential nature of progress. But it's certainly going in a direction that's in accordance with my prediction being correct, rather than the PhD economist prediction being correct. If they reversed the 23 trillion of money printing, then why wouldn't the stock market go back to 2010 levels? Why wouldn't housing prices go back to 2010 levels? The US economy and the economy of all major countries could not survive that, nor is that even necessary because inflation is not high at all. They are fighting a fiction of inflation being around the corner, which has never occurred for most of the last decade, aside from small little spikes that quickly reversed. Now, to see what the inflation picture actually is versus what the media tells you, we go to part 2 of this video. This month's inflation update brings us back to my familiar matrix because inflation has been proven as a major tool that the media uses to make people angry and frightened. And even if inflation is going down, the media doesn't want to give it up. And weird narratives about how the world is much poorer than a century ago because of supposed hyperinflation for the last 100 years are going on because the media has found the scare fuel that it has been seeking. And unfortunately, too many people are vulnerable to it. Even people who think they know that the media is rigged against them, also known as conservatives and libertarians. They're in fact the worst perpetuators of this false hyperinflation narrative, as I'll talk about in other videos. Now, my matrix over here is multidimensional for the reason that we have to take a variety of measurements to see what the holistic inflation structural situation is. That is how we get around claims that inflation measurements are rigged and manipulated, because we are taking measurements based on things that are freely traded as well as worldwide. Remember, a lot of the Americans who insist that inflation is very high tend to think that America is the only country in the world. Academically, they know it's not, but when this narrative comes up, they magically tend to forget that. And so I need the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury Yield to all be above 3% at once. If only one of these is above 3%, the other two are not, then no, inflation is not structurally high. That still comprises a noise level amount of inflation fluctuation. And the most important measurement of these three is always going to be the Goldman Sachs Commodity Index, because it prices commodities worldwide that are freely traded. So it's worldwide, and it's a basket of freely traded commodities. Therefore, the claims that it is rigged are just ridiculous and have to be rejected immediately. We all know that oil prices are much less expensive than they were even 12 years ago. Gold is also the same price as 12 years ago, and so forth. And the 10-year U.S. Treasury yield is more a measurement of future rather than past inflation, but it does affect mortgage payments and things like that. Therefore, it is one of the three legs of this stool. And the U.S. CPI is the government's official CPI metric, which is claimed to be rigged, but it's not, as I've explained elsewhere. So let's go to the Goldman Sachs Commodity Index first. Goldman Sachs Commodity Index from the S&P Global website, the URL for which, of course, will be in the description box below. The 10-year chart is this, and the average annual return for the last 10 years is minus 1.54%. Minus 1.54%. It is in deflation and pretty substantial deflation. This has to be plus 3% to be a problem, but it's at minus 1.54%. And the reason commodities are the purest measurement of inflation is because they have a very, very low labor component to them, yet they are the underpinnings of the costs of just about everything. And when commodity prices are high, a small number of people are making a lot of money, but the rest of humanity is much poorer. Whereas when service prices are higher, it's more ambiguous that inflation is a good or a bad thing, because when service prices are higher, sure, the customer is paying more, but the service provider is making more. So it's not an economic indicator per se that has a clear good versus bad indication, but commodity prices truly are. So this most important metric of all is still in deflation, proving the thesis of my Atom publication very, very well and continuing to do so. But now we go to the next measurement, which is the 10-year U.S. Treasury Yield. The 10-year U.S. Treasury Yield, this is a 5-year chart, 3.46%. So this is above 3% and has been for a short while, but it has trouble staying much above 3% because there is continuous pressure to fall back below 3%. So it has risen into the high 3s and now fluctuates in the mid 3s and just cannot go much higher than that. Remember that during COVID, it was at 0.58%, an extremely low yield. And even after all the interest rate hikes of the front end, the Fed funds rate, this 10-year yield is still at a very low level, 3.46%, but above that 3% bar that I had put forth. Now, those of you knowledgeable about this subject may remember that in the early 1980s, this was even as high as 20%, but I say even above 3% is a sign of inflation. So this is above that. Now we go to the final measurement, which is the US CPI. This is the US CPI from the BLS.gov website, and this is the CPI index level up front, and the 10-year gain is the difference between this number, 232, progressing up to 303. So in 10 years, inflation has risen from 232 to 303, and therefore what is the annual growth rate of this over this 10-year period? And right after this, we'll go to a table that displays that. But as we can see, this 1 month percentage change, after a brief flurry high that had so much media hype around it, it has moderated back down to the status quo of being in this very low band. The same goes for this 2-month growth rate, 3-month growth rate, even the 6-month growth rate, and this 1-year growth rate is already plunging fast and is halfway back down to this status quo level. The only reason this was high was not because of money printing, but because of oil prices being higher for 2 reasons. The Biden administration was obstructing U.S. domestic oil production, also known as fracking, and the war between Russia and Ukraine made world oil prices higher, and that was the only reason for even this temporary blip. But this is receding pretty far into the past. Now, another way to look at this U.S. CPI is to go to this table that I made. I have displayed this table for all of the last few months, and this table converts all of those varying time windows into an annualized rate, because some people think only an annualized rate matters, but they only say that when it's convenient to their narrative, because for them, believing in high inflation is not a data-driven belief, it is a religion. And from the most recent data that we just looked at, the 1-month CPI gain of 0.4% annualized is 4.9%, but these short time windows can be very volatile. There will be some months where this is negative as well. 2 months, 2.4%, 3 months, 3.2%, 6 months, 3.4%, because the 6-month window squared is the 12-month time frame. 1 year, 5.0%. It was as high as 9%. It's already fallen to 5%, as we just saw from that chart where the inflation value was declining. 2 years, 6.3%, 3 years, 5.8%, 5 years, 3.8%, and 10 years, the one that translates to my matrix, is still 2.7%. So still considerably below the 3% threshold and having trouble going above that. As we saw, there was 30.6% inflation over 10 years, so that is 2.7% per year. There was 20.7% inflation over the last 5 years, that is 3.8% per year. So now we go back to my matrix. So we saw all three today, May 12th, 2023. The US CPI 10-year compound annual growth rate, Goldman Sachs Commodity Index 10-year compound annual growth rate, the most important measurement of all, and the 10-year US Treasury Yield. And the results were 2.7% for the US CPI, so still below 3%, minus 1.54% for the Goldman Sachs Commodity Index. Proof that technological deflation is a very pervasive force across the economy. And only the 10-year US Treasury Yield is slightly above 3%, and perhaps not for very long, but this is the one that is above 3%. So only one of these three measurements is above 3%. I need all three of these to be above 3% before we should consider inflation to be problematic. If all three were exactly 3%, which never happens, but if all three were exactly 3%, I would actually say inflation is optimal for technological disruption and sufficiently far away from deflation, because deflation is very problematic, whether you have debt like a mortgage debt or whether you want technological progress to be fast. Deflation is problematic for both of those. That is why money printing has to be done just to offset technological deflation and bring inflation in line with this type of number series, which it is not. So I say quantitative easing is not even as high as it should be. And as I often mention on this channel, it's not even of the type of distribution that it should be. But anyway, this was the monthly update for inflation and a whole bunch of other associated subjects. So if you like this type of content, then I encourage you to subscribe to this channel, and thank you very much for watching.